Life is hard. Every day you're forced to make 100 plus decisions, with each impacting your energy levels. And by the end of the day, you're probably too tired to think. You're in no condition to be looking at 50 plus financial ratios, and you definitely don't want to waste your energy on the wrong companies. So let me tell you how to find the right companies by focusing on two simple ratios, just enough to realize whether a company is worth digging into. But first, a lovely analogy. Stocks and marriage. Finding the right partner is probably the most difficult decision you'll ever have to make. If you don't trust me, trust Charlie. If you want to ruin your life, spend it trying to change your spouse. Charlie Munger. I'm assuming most of you seek, or have sought, partners in a traditional way. You spot someone attractive, talk to them, go out for a while, and learn about each other. Then finally, you commit to a relationship. This process is somewhat relatable to investing. You spot an attractive company, read about it, do some research, and learn about the business. Then, finally, you commit to a buy and hold relationship. Since I'm no love guru, I'll focus on the investing side. And because we all live busy lives, let me show you a way to quickly spot whether a stock is worth committing to. Analyze stocks with two simple ratios. Financial advisors will 100% try to make investing complicated. After all, it's their bread and butter. But in reality, all you need is one question. If I invest $1, how much am I getting back every year? And that's exactly the question that ROE and ROIC answer. Let me tell you a bit more about them. Return on equity, ROE. ROE is like checking how well a company is using your money. It shows the profit a company makes compared to the money you and other shareholders put into it. The formula is ROE is equal to net income, shareholder equity, multiplied by 100%. A healthy ROE might be around 15% or higher. For example, if you invest $1 in a company and it makes $0.15 in profit for you, that's a 15% return. The average return on equity for a US company over the past 60 years has been about 12%. And of course, as investors, we're always aiming for above average, so an ROE above 12% for a company is worthy analyzing further for possible investment. High rates of ROE can reflect the presence of a competitive advantage with a company, especially if that high rate of ROE is consistent. If it's consistent, then the competitive advantage is likely strong and durable. But never just look at ROE in isolation. You always want to couple the ROE analysis with an analysis of ROIC as well. Return on invested capital, ROIC, looks at how efficiently a company uses all its money to make profits, including both yours and borrowed money, both equity and long-term debt. The formula is ROIC is equal to NOPAT, invested capital, multiplied by 100%. Before you get scared, NOPAT is simply like everything a business earns after taxes and paying back the banks. A good ROIC could be above 10%. A 10% ROIC is our minimum threshold when evaluating stocks, and anything above that level is even better. Imagine you lend $1 to a company and it gives you back 0.10 in profit. That's a 10% return on your investment. If you're not particularly good with math and putting together ratios and calculations such as ROIC and ROE, don't worry. Most investment analysis tools will have these figures readily available for you to observe for all of the companies covered by their platforms. But you just need to know how to interpret and use the metrics accordingly. The big difference: return on equity measures how efficiently a company is generating profits with shareholder investments, like checking in with a friend on their investment returns. ROIC evaluates a company's overall efficiency in utilizing all its capital, providing insight into its ability to generate returns from various funding sources. To maximize your investment strategy, consider both ROE and ROIC consistently over time. Consistency matters. Prioritize stocks with consistently high returns on equity and invested capital. Analyze with these two simple ratios, ROE and ROIC. But before you go, there's one more crucial aspect to consider. Be careful or you'll be manipulated. Some CEOs play tricks with numbers to make their companies look better than they really are. One common trick is taking on more debt, which can make profits seem larger because it shrinks the shareholders' equity. To spot these tricks, keep an eye on two important ratios, ROE and ROIC. ROE shows how well a company is using its equity, while ROIC considers both equity and debt. High ROE might seem good, but it could be because of too much debt. Another trick is share repurchases, where a company buys back its own shares. This can make earnings look better without actually increasing profits much. It's like trying to boost your grades by changing the class size. Don't just focus on high ROE. Some companies deliberately reduce their equity with big dividend payments or share buybacks to inflate their ROE. Look at ROIC too to get a clearer picture. Remember, both ROE and ROIC are important for understanding a company's financial health. Keep an eye on both to make smart investment decisions. Subscribe for more tips, stay informed, and make wise investment decisions. Happy investing. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.